Okay, so welcome everybody. Thank you to everybody that's joining us this afternoon. I will just give it a couple of minutes to let everybody join us. Just you can see me hopefully, but I can't see you. So if you want to eat your lunch or have a little snooze or go off and walk the dog, then that's absolutely fine. There is a questions button. If you want to ask any questions, you can do that during the course of the webinar, or we can answer those at the end. Or if you have anything that you think of, then obviously just drop me an email afterwards and I can come back to you on those. So we will get started just by me telling you a little bit about myself. There I am again. So I have been a corporate lawyer for 25 years this year. I started off in Leeds and I wanted to be a criminal lawyer or a litigator originally, and I was told that I had to do a seat in the corporate department, which didn't interest me in the slightest, but they made me do it, and I discovered actually that corporate law was quite interesting, and the rest is history. So I do all sorts of what we call corporate law. I prefer to call it business law, really. Anything from corporate contracts through shareholders agreements, and the company sales and purchases, which is the interesting bit and the bit that I enjoy the most. So today, really, that's what I'm going to talk to you about. And I'm going to talk to you about preparing your business for a sale. But also, before we start on the sort of the legal bits, a little bit about preparing yourself for the sale as well. It can be really quite a stressful process. It's very intense. There's a lot that goes into it. And so it's important to acknowledge that, and to just be mentally prepared for that. I once did some work for somebody who was a solicitor, who halfway through the due diligence process just said to me, Jessica, I can't cope, and he took himself off and he went walking in the Lake District for a few days. His buyer wasn't massively happy, but it just, he was overwhelmed by the whole process. So I think it's important to understand that, prepare yourself for it, and remember that also not only are you selling the business, but you have to run it at the same time. So that in itself is quite a big undertaking. So I think when we look at the sort of the preparation and why are you selling, in a way that all ties in to some extent, because if this is the end of a 5-year plan, and this is, you've been growing the business and working towards this, that's a different process from the situation sometimes where sadly people have to sell because of illness or the illness of a family member, or they've just had enough of the business. And I think that is a very different position, and it will affect how you feel about the process, what you're prepared to accept in terms of the money, and how that's going to look. So within the sort of the preparation, it's important to think about those things, and to think about how the whole process is going to look for you. So in terms of readiness, that's quite that mental readiness, and that knowing your why is quite important. So when you're thinking about preparing the business, and we're talking about 6 months, a year, 2 years before you even start to look for a buyer. We're talking about this sort of preparation and the thinking through how the whole process is going to work. So I've put here, consider the market position, the customer base, and the revenue stream. So when you're thinking about the market position, is it sustainable? Is where the business is now, has it had a couple of particularly good years for some reason? You know, you're selling hospital beds during COVID or those sort of things. You know, is it going to continue in that vein, so that when you come to selling it, or when you come to explain to a buyer where the business is at, is it going to continue either increasing or plateau, or hopefully, you know, not decrease for any reason, and if it does, can you explain that? Think about the customer base. What are they? Who are they? How many customers do you have? If you have just one very large customer, obviously that's less attractive for a buyer. There's quite a big risk there. So if you do only have one or two large customers, it's thinking about how you manage that, how you manage them, how you introduce a buyer, and just being aware of, I suppose, how your business looks from the outside to somebody looking in and considering where the risks are there. And along with that, so we talked about market position, along with that, a steady revenue stream and a business plan. Where's the business going? Where would your vision for it be? So that you can sell that to a buyer as well. We are here now, but this is where we're going. This is where we could be going. And once you've done that sort of exercise, to the sort of the what do we look like from the outside, it's identifying any issues or weaknesses. So effectively, a buyer is going to come in, they're going to do a due diligence process, they're going to ask lots of questions, and this sort of internal due diligence, it anticipates those questions. It anticipates the, why do you do it like this? Why haven't you done that? What happens if? And so it's just going through those, and looking at issues, weaknesses, areas of improvement. Is your IT system up to scratch? All of those sort of considerations. Are there any consents or approvals needed? So do you need some sort of license? You know, are there any licenses involved that will need to be transferred over? Are there any mortgages or charges? Do you need to be speaking to the bank to get those released? And internally, is everyone on board? Has everybody consented to this? I did have one situation where it was a family business. The family had all got together and said, we're going to sell the business. Everybody said, fine, that's great. When it came to actually doing it, one of the shareholders, who was a minority shareholder, had disappeared. He'd gone to live off grid in Scotland and nobody could find him. So we had search agents, lots of people trying to find this shareholder to get him to sign up. And he couldn't be found. So there were two options in that situation. You either don't sell the shares, you sell the assets, and we'll come on to that later. Or what we did was, there was quite a long process to change the articles of association, to introduce a tag-along clause and a drag-along clause to make sure that we could sell his shares without him actually signing up to anything. But those sort of things are just things that you need to think about. Similarly, I've had a couple of situations recently where the stock transfer forms, the company books haven't been up to date, and that can cause issues. So one where the company had been formed by a formation agent and then transferred to the shareholders, but there was no record of the stock transfer form transferring the share from the formation agent to the two shareholders, and the buyers, it was actually the buyer's bank, said, well, we don't know that this company belongs to them. So again, that was quite a long process to get that sorted out. So it's anticipating those, and just bear with me 1 minute, my computer is trying to restart. It's anticipating those and trying to iron them out before you begin that sale process, and it avoids you having to give indemnities during the sale process and in the agreements, which could have a financial implication for you. I once sold a fisheries business, and it involved quite a lot of water and ice. They'd been running their water supply off the domestic water supply, which was discovered during the due diligence process. And obviously the cost implications of that for the buyer could have been quite significant. And so they wanted an indemnity from the seller that says, if there's any comeback, you will pay for this when we're not taking responsibility for this. So it's looking at all those things and going, what could go wrong effectively during this process. Okay, so who do you need to talk to? Your lawyer. I'm going to say that. Your solicitor, your lawyer will advise you on the structure, the documents that you will need, the due diligence, all that sort of process. And it might be that you need corporate advice, you need property advice, employment advice, tax advice. So all of those different aspects will come in during the drafting of the documentation. We'll talk about what documents you might need in a bit. Your accountant is always going to be massively important in this process, and if you don't have one, then you need somebody who can help you with it. Often people will have spoken to their accountant before they come to us, but it's the accounting aspects obviously go to the structure, how much tax you're going to have to pay. So the structure might depend on the tax implications. You will need somebody to help with the accounting due diligence. The accounts obviously are integral to any sort of business sale. So you need to have them there to help you with that, and also to look at any warranties that you're being asked to give on tax and that sort of thing. You might want to talk to a corporate finance advisor or an agent who can help you to market the business. They will know the business area quite often. They will know who the competition is, who might be looking to buy a business, and they can help you negotiate that deal. I haven't put on this slide, but also financial advisors are quite important. You might want to talk to somebody to say, what am I going to do with all this money once I've sold my business? And they will also help you potentially to think about the structure, because knowing what you want to do with it afterwards can help you to work out how that deal is going to look. And then employees, which of your employees do you need to tell? Do you want to tell? You might find that your HR advisor needs to be involved, because there's lots of employee information that the buyers will be looking for. So it might be that you don't want to tell anybody, and that's fine. But it might be that it will help to take some of the pressure off if you have trusted employees that you can involve in the process. So One of the things that we talk about quite a lot is whether or not you're going to sell shares in the business or the assets of the business. There are lots of decisions that might drive this. Quite often, it's a tax-driven decision, but there are legal implications and practical implications for each of those. So when you're looking at an asset sale, it's quite attractive to a buyer because you keep the historical risks and liabilities of the limited company. So the shareholders keep the actual company, and the assets just get sold out from underneath it. So a buyer can sometimes pick the assets that they want. They can leave behind the liabilities that they don't. It's easier from a due diligence process because you're not, again, going into those historical trading and the sort of previous history of the company. So that makes that slightly easier. And when we were talking about the missing shareholder, obviously it's a director's decision to sell the assets and the minor, depending on your articles and your shareholders agreement, but the seller will be the company, and so the minority shareholders won't be able to prevent that sale. The converse of that is that the sale proceeds will go to the company, so you don't get the money in your hands immediately. It goes through the seller that is the company, and then usually we'll end up with the shareholders by way of a dividend or other payment out. But again, that's tax advice needed on that aspect of it. And you may find that you're left with either some assets or the company to wind. So there's some tidying up to do, some loose ends to be tied up. It's not a we can sell this and walk away sort of situation. Where you're selling assets, TUPE will apply. So that's the employee rights, and the employees have to be informed and consulted prior to the sale. So they need to know what's going on. You need to identify exactly what's being sold. So any sale contract needs to say, these are the assets that are going, these are the liabilities that are being left behind, and make very clear on what's going on there. You might need consent because the contracts will be in the name of the company, and that includes your property contracts as well. So there will be a change of ownership, and all of that needs to be dealt with. And an asset sale generally is more tax efficient for the buyer rather than the seller. So as the seller, probably you're going to be looking at a share sale. It's neat, it's tidy. You sell the shares, you walk away, and everything is then included, and the money will come directly to you, which obviously is a benefit. Because the employer doesn't change, the contracts don't change, the leases don't change, the legal identity is the company, and everything remains with that. So there's less admin from that point of view, but contracts and that sort of thing should always be checked, just to make sure that there isn't a change of control clause that would prevent a change of the majority shareholder, or that would require consent on the change of the majority shareholder. Obviously, it requires the support of the shareholders. You might find that you have a shareholders agreement or articles that include what we call a drag-along clause, which means that if the majority sells, the minority have to as well. That's something that you might want to think about in a year, 2 years prior down the line, looking at your shareholders agreement and your articles to make sure that they're ready and they include the provisions that you need them to. It also, things like the shareholders agreement, just sort of signals to a buyer that that you've thought of everything, the company is all in order and everything's been covered. So it's quite a good thing to put in place. And then on a share sale, obviously it's more tax efficient generally for the seller to do it that way. So finding a buyer is quite an important part of the entire process. Think about whether there are employees within the business. So could you consider a management buyout? Is there somebody senior within the management that's keen to take on the business? You could look at the employee ownership trusts. And then other third parties within the same industry. So what do your competitors look like? May they want to buy your business? Would you feel comfortable with them buying your business? But that's always a good place to look. And obviously you can appoint an agent to do that hard work for you. There is always a fee associated with that, and it's usually quite a high fee. And you have to just consider the paperwork that's involved in that as well, because there's some thought around who has introduced a buyer. So if you've talked to somebody in the industry previously, and they then approach you, who has introduced that person. So it's just again checking that everything is in order when you do that, to make sure that everything goes through as it should. So valuation is always important, and sometimes a tricky one. You may have in your mind a value for the business, and it's good to have to think of the figure at which you will feel comfortable. That's your higher figure and your lower figure. So having a realistic expectation, but the point at which you go, do you know what, this isn't worth me selling. I'll just carry on. You can always get a professional valuation, and your accountant will help with that. There are people who will value the business professionally, and give you an idea. And there are various ways to value different businesses based on sort of multiples and looking at similar sales within your business area. And then once you've decided what the value should be, thinking about accepting offers. Will you shift slightly on that if you find the right buyer? And the valuation that you've agreed can then be paid in a number of ways. It can be paid all up front. It can be paid some up front, and then some as what we call deferred consideration, so in stages over a number of months or years. And you might decide that you'll accept a slightly lower figure for the business if a higher percentage is paid up front. Or you might say, well, I want slightly more money, but I'll give you longer to pay it. And that's all part of the negotiation process. If you are selling the shares in the business, sometimes you look at doing a completion accounts mechanism to work out actually how much money is there in the business. So do you want to take all the cash out? Do you will there be a set amount of working capital left in there? A couple that I've done recently have had what is effectively a working capital loan. So the sellers have said, well, we'll leave £50,000 in the bank account, and you can pay me it back over the next year. And that just helps the buyer, because they know that it doesn't matter where in the month that the transaction completes. if there's some money in the bank account, you know, the employees can get paid and that sort of thing. If you're going to have deferred consideration, is it a set amount? So if your value is £1 million, you get 500 up front and 500 over the next 2-3 years. Or is there some sort of earn out? So does the buyer say, well, I will give you that £500,000, but the business has to hit these targets? And again, that's a negotiation point, and that goes to the price adjustment based on revenue as well. If you're going to accept deferred consideration, so payment over a number of years, do you want some security for that? We would always say to a seller, you're effectively lending part of the purchase price to your buyer. So do you want a charge over the property, or some sort of charge over the business? And that's, again, it's a negotiation point. It's also a negotiation point if the buyer has any funders as well, because if they're lending that money to buy the business, any security that you have, they're probably going to say, well, that needs to sit behind us. So again, it's all those sort of things to think about, things to have clear in your head when you start the process. What do I want this to look like, and what am I prepared to accept it looking like in order to get the transaction done? So hopefully we've got as far as a buyer, and what happens then. So initially, you're going to look at some sort of confidentiality agreement. So you are going to be handing over information to them, obviously. It's going to be information about your employees, it's going to be information about your accounts, your customers, all of that information. So you want to know, particularly if there's somebody within the same industry, that information isn't going to go anywhere else. Now, a confidentiality agreement will not stop them from taking that information and using it, but hopefully it will deter them. And then once you've done that, you would move to looking at some heads of terms. So what exactly have you agreed, and putting that down into a document that largely isn't legally binding, but provides the framework for the agreement that you've come to, and it avoids any misunderstandings or any discussion later on in the process about what has been agreed. In terms of the due diligence process, and this list is quite a good one for you to look at, to use when you're thinking about the preparation, looking at the areas of the business that a buyer will ask questions about, and saying, you know, where is that information? Have we got that information? Can we find it? Is it in a box in the back office? You know, is it on a system? Is it digital? Can we easily supply that information? Because your buyer is going to ask for a lot of information, and so ideally it's going to come in some sort of digital format, rather than just a box of paperwork that then has to be scanned in. You know, that's then becomes quite a long and painful process. So all of these things, where are they, and how do you hold them? So it's being able to find those things. So they're going to ask questions about the corporate structure. So that goes back to, do you have your statutory books? Do you have all the stock transfer forms, that sort of thing? Who owns what? That's quite important. The accounts, obviously, really important, to have those up to date, easily accessible and understandable as well. Banking and finance arrangements. So what are the, is there an overdraft? Are there any mortgages? Is there are any of the assets leased, or are there any other finance arrangements that will need to either be transferred or paid off on completion? We're still looking at things like bounce back loans and all those sort of things that need either dealing with or factoring into the price effectively. There's going to be a lot of questions about employees. Are your employee contracts up to date? How many employees do you have? Are there any sort of grievances or employee processes that you're going through? Have you offered to employ more people? Are you making people redundant? Are you looking, is there a hole in the employment? Do you need a finance director? All those sort of things. People, they're going to be asking those questions. And similarly, material contracts. Who are those contracts with? And those could be your customers, and those could be your suppliers. So who is important to the business in that sense, and will they stay with the business if it changes hands? Obviously, the IT system, is it up to date? Does it work? Does it do what it needs to do? Intellectual property, what is it? Is it protected? Will it transfer? And then real property and leases. Obviously, there will be questions about the property. Is the property owned? Is the property leased? Will that transfer? And then back to talked earlier about the licenses and the regulatory permissions. So, if it's a pub, the alcohol licenses and that sort of thing, or we do some like financial advisors and all those sort of regulatory issues, dentists, that sort of thing. So there's all sorts of things to think about there. Compliance policies, is everything as it should be with your handbook, with the compliance within the business? Things like data protection, have there been any data breaches, and how have those been dealt with? Insurance, is it in place? Is it up to date? Have there been any claims? Are all questions that are going to be asked. And also, is there any litigation? Has there been any litigation in the last 3 or 5 years? And what happened? How was that settled? And then under that needs shifting left slightly. We're back onto the document. So once that due diligence process has happened, and hopefully the buyers are happy, and the due diligence process, what will happen is they will send out a questionnaire, which will have all of these questions on. We will provide the information to them, and they might then come back with more questions based on the information that's been provided. So it's being prepared to provide that information, but then for them to come back, the other side, your buyers, solicitors, and this might happen once, twice, 3 times, to say, well, what about this? And what did you do about this? And what happened here? So there might be follow-on questions that come from that, and that's not unusual. But hopefully, eventually, you get to a position where there is an agreement to be drafted. That agreement will cover, obviously, the payments that have been agreed and how that's going to be structured. It might have a completion accounts process within it for those adjustments, and it will contain a set of warranties. Now, the warranties within that agreement are statements of fact that you give about the business that go to supporting the valuation and the price that's been agreed. And the warranties will roughly cover those areas, the same areas that the due diligence process has covered. And so those statements of fact will be statements that you give to say that everything is as you've said it would be. So the warranties might say there have been no employee claims in the last 3 years. If there have been employee claims within the last 3 years, then we produce something called the disclosure letter, and the disclosure letter says in April 2024, ex-employee made a claim that. And so we make that information clear so that there's no claim under the warranties in future, because what happens is if you give the warranty and it turns out to be untrue and there is a financial repercussion such that the price that has been paid is deemed to be reduced, then a warranty claim can ultimately lead to the seller having to give some of the money back to the buyer if the amount of the claim, or the amount by which the warranty effectively is untrue, is significant. And then obviously you've got your agreement, you've got your disclosure letter. Have you agreed to take any charges over the property, or over a personal guarantee from your buyer in relation to any deferred consideration? And we would look at those as well. And then there's a load of what we call ancillary documents. Those are things like the stock transfer forms, the board minutes, the company's house documents. So those are all part of the process, directors' resignation letters, all those sorts of things. And one thing, talking about resignations, that I haven't sort of considered or talked about is considering also whether you want to stay on with the business for a period after completion. It's quite attractive for a buyer sometimes to have that comfort, the knowledge that the seller will be there for a month, 3 months, 6 months after completion, just to have that handover, or is working in your own business for somebody else, is that just your worst nightmare, and do you want to walk away? So that's also something to consider within the process. So I've talked at you now for about 40 minutes. There's a lot of information there, and as you can see, there's a lot of things to think about, and so it's good to really to start to think about those things that well in advance of the process. It does make it a lot less stressful if you've had those thoughts and considered all of those things, and have in mind how you want it to look, how you want the sales to look, how you want the process to look. It's never always going to go entirely to plan, but it's good to have thought about it, to have planned it out, to have structured it and thought about that, and to know that the business is in the right place to begin that process. I can't see that I've got any questions at the moment. If anybody would like to ask me any questions, then I'm more than happy to answer those. Say, drop them on an email to me, or just give me a call if anything's made you think, made you concerned, or you just want clarity on anything that I've said. But if not, thank you very much for joining me. I hope that was useful, and we will look to end the webinar if there's no further questions. Thank you.